On today's episode, we're going to check in on those mortgage interest rates, what's been going on, where they seem to be going, the National Association of Realtors' January existing home sales data, a very interesting fun fact from the 1500s, and then we're going to wrap it up talking about adjustable rate mortgages. Let's go. Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I hope you're all doing well and having a great week. We've got a lot to cover today, as usual, so we're going to get right into it. Let's talk about where these average mortgage rates are as of the recording of this episode, the Thursday morning before its release, here to end off February. According to Mortgage News Daily, the 30-year fixed-rate mortgage is averaging 6.78%. The 15-year fixed-rate mortgage is averaging 6.24%. The 30-year jumbo fixed-rate mortgage is averaging 7.09%. The 30-year FHA mortgage is averaging 6.13%. The 7/6 SOFR adjustable rate mortgage is averaging 6.65%. Bonus interest rate today, the 5/6 SOFR adjustable rate mortgage is averaging 6.37%. We're going to get into those adjustable rate mortgages a little bit later. Taking a look at the bond market, as of the sampling this morning, the 10-year yield is at 4.266%, the 5-year yield is at 4.096%, and the 2-year yield is at 4.082%. Across the board, in the survey of all of the mortgage rates and the bond market, everything has suppressed quite a bit. Why did this happen? Let's find out. First and foremost, the biggest market mover that occurred was on Friday last week. So on Friday, we had the publication of the S&P Flash United States Services Producer Manufacturer Index. The Producer Manufacturer Index, again, we talked about this last week. This is the data point that shows you what it costs for the producers that wind up providing the services. And we're talking about the services sector. The United States economy is a 75% services economy. So what we see here becomes a very important element when the people are watching the quote-unquote data, because the Federal Reserve is data dependent currently, as consistent with their messaging over the past couple meetings, as well as the commentary outside of the meetings. This services PMI, Producer Manufacturer Index, came in at 49.7. This is below the expectation of 52.8 and also below the previous reading, which was 52.9. It's a quick refresher here. Anything above 50 is expansionary. Anything below 50 is contractionary. This is one of the first times we've seen this come in the contractionary territory, albeit only by 0.3 into that contractionary territory. But because of the miss based upon the expectation, the market digested this and there was a bit of a sell-off in the market, which means people sell their stocks, equities, and they go into things like bonds. Again, we get more buyers in the bond market, the prices go up, and then the yields go down, hence why we're seeing this softening and cooling in the bond market and those yields coming down. We also had the manufacturer PMI. So this is United States manufacturers, the cost for the producers before it reaches, and that index came in at 51.6. Slightly above the expectation, actually, of 51.5, and still down, though, slightly from the previous reading of 51.8. Why is this important for us? Why are we talking about manufacturing? And we're getting a little markety here. These are tangible reports that have made an impact on the market. This is the source of the relief that we're seeing in the interest rates that were just reported out. Most importantly, I'm going to say over the next week, we're going to have much more important data next week that's going to definitely impact interest rates. Whether they go up or down remains to be seen. But if we're starting to see the signs here of what these producer manufacturer indices look like between services and manufacturing, well, now we're going to start to see what inflation looks like, particularly next week with the Fed's preferred inflation gauge getting reported out, the PCE, personal consumption expenditure. In addition, we're also going to get the ADP employment report. job market and inflation. Those are the two. Those are the two most important things to the Fed currently while they're addressing their monetary policy. We're going to see what that looks like next week, and I'm excited to share. I'm pretty sure the PCE is going to come out after the release of my episode, so it may be 2 episodes away that I report out on it, but the effects will happen, and the benefit there is not only will I be able to tell you what that personal consumption expenditure looks like, I'll be able to also report out as to what impact that had on interest rates and on the market. For today's exploratory idea, as mentioned, we're going to get into the National Association of Realtors existing home sales data for January, which was just released this week. So from a high level, existing home sales declined 4.9% month-over-month decrease to a seasonally adjusted figure of 4.08 million homes sold. The price growth is still permeating the market. We're seeing the median existing home sales price increase 4.8% year over year to a figure of $396,900 for your median home sale in the United States. This reflects 19 months of price gains. So for 19 months, we're coming up almost on the 2-year anniversary of almost 2 years of continual price appreciation in real estate. I'm going to put an asterisk there. I'm going to return to that. The affordability challenges obviously are still persisting. Interest rates have not changed in that time, not meaningfully downward for sure. We had a pocket of some relief in August of 2024, and that was about it. Otherwise, we've been kind of humming along here in this 7% margin, plus or minus, depending on the day. And obviously right now, we're seeing some of the lower interest rates. If we look back over the past 52 weeks, we're kind of sitting in the middle of the range of where interest rates have been over the past year. I'm not going to go into each region. I'm situated here in Totowa, New Jersey. Here in North Jersey, we're going to exclusively cover the Northeast and also understand that there's going to be some differences between this national perspective, looking at all home sales throughout the country, and what's happening a little bit more locally here in the Northeast. So sales in the Northeast declined 5.7% to a monthly decline of 500,000 annualized transactions. These are, when we say annualized, it means it's adjusted for the seasonality. And the transactions are still 4.2% higher than January of 2024. So we saw easing happen December to January, but when we look back, there's still some improvement. So a little bit of a mixed bag here. The prices are up, though, here in the Northeast, 9.5% year over year. Median home sales price in the Northeast, $475,400. This is the highest regional appreciation, and that's due to this limited inventory. There's not a lot available, pushing competition even higher. Overall, inventory trends throughout the country, well, unsold inventory actually increased 3.5%. These are homes that did not sell and that are still on the market. And again, this is a national representation. And that's 1.18 million homes, seasonally, annually adjusted, equaling 3.5 months of inventory. As another reminder, I mention it every time we report out on the National Association of Realtors existing home sales data. A healthy amount of inventory is around 6 months, and we are still pretty far off of that. Supply and demand imbalance continues to persist in the market. The supply lacks, the demand continues to grow. This is going to wind up creating more and more problem as time goes on. And some people are waiting for inventory to open up for there to be more homes that are available. But there's an important thing to note on that. I had a wonderful meeting yesterday with a realtor partner of mine, and the discussion was surrounding this. And one of the elements that not a lot of people recognize is when more inventory becomes available, that means you have more people selling. Most of the time, especially if they haven't sold yet. Let's be honest with ourselves. The reason why people are selling right now are because they absolutely have to. Anyone who's making a judgment call on whether or not to sell, normally they're not selling. They're staying on the fence and waiting it out. So debt, divorce. These are the top 3 reasons right now most people, particularly speaking to the Northeast, most people are selling. Part of the reason why they're not selling, for those people who are sitting on the fence, where are they going to go? While inventory is what I'll call anemic, they don't know where that next step is going to be for them to move. And then if they do that, there's a ton of competition. So to go back to my point in the conversation I was having yesterday, something that people aren't aware of, when the inventory goes up, competition is going to go up. And the competition that's going to be present in that market are people selling their homes. We just talked 19 months of price appreciation. People who sell are likely going to be sitting on a lot of equity. When they're buyers in the market, they're going to be super competitive to deal with. We're going to get into that in a second because there's even more competition that continues to persist, which is a bit of a head scratcher for me personally. But if you're going to have that timeline waiting for more inventory, it may not be the move. We just talked 19 months of price appreciation. We can only look to that so far. Doesn't necessarily mean that's where everything is going over the next 19 months. Anything can happen. Real estate doesn't exist in a vacuum. It is also reliant and dependent upon inflation, upon the job market, upon a number of different things in the markets. So when we're considering all of this, we need to take into account quite a lot. But if you're going to take anything away from this part right here, here's the point. When there is more inventory, competition will increase as well. So bear that in mind. Does it make sense maybe to start fighting and duking it out in this current market, albeit it is still competitive here in the Northeast, particularly in North Jersey? It may still be worthwhile to take up that fight now instead of battling it out with other buyers that are selling property that could very possibly have quite a hefty down payment because of the equity they have in the homes they're selling. Speaking of which, let's talk about the buyer composition that we got from this report. So with mortgage rates being at around 7%, it continues to hamper affordability, and that, by the data from this report, translates to consuming about 25%. 25% of median household income going straight to housing payment. It's kind of crazy. First-time homebuyers, they accounted for 28% of the purchases in January. That's slightly up from 2024's record lows, but well below what the average norm is when we talk about buyer composition. Buyer composition, historical average for first-time homebuyers, 40%. So we're making progress looking back in the short term, but when we zoom out, we're still well away from getting back to a normal market and a healthier operating market. Cash transactions. This is where I put that asterisk. Cash transactions accommodated 29% of the sales in January. That's really tough to compete with when you have financing. Now, here at Rate, we have some strategies that have proven to be successful to beat out cash, and there's ways to do it. But the fact that there's still 29% of the transactions in January that were cash is kind of crazy. I personally had been expecting for some time that we would start to see a decline. And at this point, after all the COVID relief money was gone for years now, and we hear about the American consumer drawing down on their savings because of the high inflationary environment, we talked on past episodes about that really big affordability gap, with wages only increasing about 8% in the time period from November 2019 to November 2024, while inflation price increases were in the range of 22%. Well, that gap creates a drawdown on savings or further extension on credit and overextension on credit, things like credit cards. But there's still a lot of cash out there. There's still a lot of cash out there to compete with. So it's really important that you work with a mortgage professional that can implement winning strategies for you if you're a prospective home buyer. So bear that in mind. Overall, if we're just going to look at the total picture here, this is not a report inconsistent with what we've been seeing on a monthly basis for quite a while now. We know the rules of engagement. Now it's up to us, for me as the professional assisting the families and clients that I work with, to best prepare them, best prepare their expectations for what it means to be a buyer in this real estate market and what we can offer and what we can do to help shorten up the the time for shopping and be as effective as possible so that you have a winning bid accepted sooner rather than later. For our fun fact today, we're going to go back to the 16th century. 1518 was the year, and we're going to go to Strasbourg, France. And in 1518, there's a story about the dancing plague. Now, there's speculation as to what caused this, but I'll just share the information that I was able to find. In 1518, in Strasbourg, France, it started with a woman who started dancing in the street. And then before you knew it, more and more people were out in the street and dancing. And they were out there dancing to the point of exhaustion and cardiac arrest, legitimately dancing till they dropped. Historians still aren't 100% clear as to what could have caused this, and there's numerous theories. So there are some theories that maybe there was mass hysteria in the area, or possibly there's theories of ergot poisoning. Ergot is actually a psychedelic that historians have found presence of in things like wine and fermented beverages. So in this case, there's a working theory that maybe rye, one of the beverages that was consumed at the time, had ergot poisoning, which is a psychedelic that could have, for lack of a better term, overdosed this population and caused them to dance in the street until they dropped. So there's your fun fact. Please feel free to share that as some fun conversational fodder in your weekend ahead and in the week ahead. For our Did You Know segment today, we are going to cover adjustable rate mortgages. This is going to be a full scope overview. And the reason for this, over the past 2 to 3 weeks, I have noticed that adjustable rate mortgages are now starting to provide more beneficial interest rates for their initial period. I'm going to make more commentary about the current market after I provide you with all the information about adjustable rate mortgages. So what is an adjustable rate mortgage? Back into acronym city we go. We're going to call it an ARM, ARM, adjustable rate mortgage. Plainly said, it is a mortgage that has an interest rate that adjusts, as opposed to what the lion's share of the interest rates I report out on every week. They're all fixed rate mortgages with different terms, 30-year term, 15-year term, whatever it may be. Adjustable rate mortgages operate a little differently. They do adjust over time, but not immediately. They start off with an initial locked-in period where your interest rate does not change. And it can vary. It could be as short as 3 years, 5 years, 7 years, 10 years. These are the customary years where you have your initial lock-in period. Then it adjusts. It can adjust semi-annually, which means every 6 months, or it can adjust annually. These are the two most commonly adjustable time horizons when you have an adjustable rate mortgage. How does it adjust? Great question. It adjusts based on two components. The adjustment component is what we call the market index. That means your adjustable rate mortgage, your ARM, is tied to a particular index in the market that is operating freely in the market based on how investments are going, what's going on in the market. What we're going to focus on today is the secured overnight funding rate. This is now the commonly used market index for ARMs. Previously, it was the LIBOR rate, the London Interbank Exchange. I'm butchering that a little bit, but if you look up LIBOR, you can get more information on what LIBOR was. It's not as important anymore because the market has moved away from it as a market index. Now, most commonly, adjustable rate mortgages are tied to the SOFR, SOFR, Secured Overnight Funding Rate. You can go online, you can see the history of the SOFR. That's the first component of the interest rate. The second component of the interest rate is the margin. So you have the index, and when you add the margin, that gives you what's called the fully indexed rate. That shows you at present, if you were to get an ARM mortgage, adjustable rate mortgage, you can see, all right, if my margin is, let's say, 3%, and the SOFR right now, I think it's in the 4.2 range, 4.3 range. So let's just say it's 4.2. And you have a 3% margin. That means your current fully indexed rate would be 4.3 plus the 3% margin, which gets you to 7.3%. That would sometimes, depending on the length of your initial lock period when you're applying for an ARM, could be the rate that you need to qualify with. So you don't pay that interest rate because you have a discount in the initial period. But when we work on your mortgage application, we may need to use that fully indexed rate to qualify you, because we are going to think to ourselves, and the theory behind the underwriting approach when they review your documents and review your qualification, let's say right now is the same market it is at the end of your fixed period of your ARM. Well, this is the indicator we have now, so we're going to just go based on this information. It would be 7.3%. Do you qualify for that monthly payment? If so, we're good to go. If not, it's going to preclude you from this type of financing. Next are caps. So we've established now the index and the margin. That creates the interest rate you qualify with in some scenarios, and that also lets you know what it would look like when you're done with your initial lock period. The next component to consider are what they call the caps. Now, the caps on the ARMs are dictated when you identify the loan program. So if I'm going to present a client with an adjustable rate mortgage option, I'm going to inform them of what the caps are. And the caps are applied to what your initial interest rate is. And this is how they operate. You may see an adjustable rate mortgage promoted, like we talk about every week, the 7.6 SOFR adjustable rate mortgage. The 7 means you have a locked-in interest rate for 7 years. The 6 means you have an adjustment after the first 7 years. You have adjustments on that mortgage rate every 6 months. So every 6 months, wherever the secured overnight funding rate is, that plus the margin is the interest rate that you will be paying at that time. There are caps, though, for the protection of the borrower and for management of the financing. And the caps are normally outlined as three numbers with slashes between them. So, for example, in this 7.6 SOFR ARM, let's say you see 7.6 SOFR ARM with 2/1/5. The first number, that 2, that indicates the cap at your first adjustment. So at the end of 7 years, whatever your interest rate is from that initial locked-in period, it cannot be more than 2% more than what that current rate was that you were repaying at for the prior 7 years. So that's your initial cap. So it adjusts in that initial, the first adjustment after 7 years, that's your new interest rate based on the index and margin. Then the 1, we said 2, 1, 5. Now the 1. The 1 is there for subsequent rate changes for your adjustable rate mortgage. That is the cap for each adjustment. So now moving forward, let's say market has not changed at all. Or even better, let's be optimistic about this. Let's say you have a 7.6 SOFR and it has a 2.15 with the caps, and your initial adjustment actually goes down. So the cap doesn't apply, right? Let's say now your interest rate is, for easy numbers, 6%. Let's say rates go down, and 7 years from now, that's what your index plus margin is. So now your interest rate is 6%. The next adjustment is 6 months later. Remember I said 7.6, 7 years fixed, every 6 months adjusting. Now, 6 months later, your interest rate's going to adjust again. Now let's say SOFR goes up. That's the only thing that's going to change your rate, what that market index does. Let's say it goes up, but it can't go up more than 1% of what you were paying at that time. So now your cap is 1%. So if you're at 6, it can only go up to 7%. That's your adjustment cap. That's that middle number. Now we have our lifetime cap. We mentioned 2, 1, 5. The 5 is the last one. That's called the lifetime cap. The lifetime cap is based on what your initial interest rate was. So let's say you had an initial interest rate at 6.5% for the 7 years in your repayment. If you had a 6.5% interest rate, add 5 to that. That means your mortgage rate can't be more, I know, yikes, 12.5. Or I'm sorry, 11.5%. My gosh. Early in the morning, mental maths are not working. So let's say it's 11.5. That is your lifetime cap. That means no matter what happens in the market, you will not pay more than 11.5%. now thinking logically through this, you have a 2% cap in your first adjustment. So at most, it can go up once there. Let's say, worst case scenario, rates are going up. Now your rate's adjusting. So you're going from 6.5% to 8.5%. That's your first adjustment. So then we have that 6 months later, let's say it just keeps running up. 9.5 every 6 months. 10.5 next. 11.5, 3. So we're talking about 3 6-month periods that it would take to reach that max in a worst case scenario. That's just something for consideration on the absolute worst side. But the other benefit is most, and now we were talking about caps. This is interest rates going up. Now let's talk about how low can you go most of the time. And I'm going to paint with a broad stroke here, but it's very important to ask this question. If you are entertaining an adjustable rate mortgage, you're going to want to ask, what is the floor? And the floor is exactly what it sounds like. It is, what is the base rate that my interest rate can adjust down to while I have this adjustable rate mortgage? I know customarily, I just assisted a client with this. The floor rate was the margin. So that assumes in a world where the secured overnight funding rate is 0, well, if there was a 3% margin on that loan, then 3% is the lowest interest rate that would be possible. So now, to recap, we have a 7.6 SOFR adjustable rate mortgage 215. 7-year initial lock period, same interest rate for those 7 years. After 7 years, it adjusts every 6 months. 2% cap on the first adjustment at the end of the 7 years, 2% cap. 1, every subsequent adjustment cannot go more than 1% of where the interest rate was prior to the adjustment. 5, that is your lifetime cap. 11.5% if your interest rate started out at 6.5. Clear as mud? I hope that was helpful. Now let's talk about some of the pros and the cons. Pros, let's talk about right now. This is where I'm going to give you the current market data. Currently, over the past 4 weeks, because of what was happening in the bond market, we talked about the 10, the 5, and the 2. Adjustable rate mortgages tied to secured overnight funding rate, but that's an element in the market, like I said, contextually within where people are investing and market volatility and movement all has an impact. Well, as the bond market yield curve flattened, which means the shorter end treasuries, if you're going to invest 2-year, 5-year versus 10-year, they are lower yields and they step up to 10 years. That indicates a healthy market. Longer term money gives you more yield. Well, because of this change in the bond market, the yield curve now flattened from the inversion that we had for a very long time, and that's created a market environment more conducive to adjustable rate mortgages because of how the trading is occurring in those markets. So if we're looking at that, and over the past 4 weeks, I have seen a tremendous benefit to adjustable rate mortgages, sometimes by a very wide margin. Most of the time, you do need to pay discount points up front. I did cover that in a previous episode, but I think we may revisit that soon. Discount points, for a brief refresher, are a way that you can pay up front for, it would be a premium based upon whatever the current market rates are, and it can give you a lower interest rate for that introductory period, which could make a lot of sense. And dollar for dollar could go a lot further. For the client that I assisted recently, that was the difference between having a 6.8% mortgage on a 30-year fixed, and then they were able to secure a 5.9% mortgage on a 5.6 SOFR ARM 215. It's pretty amazing. That's quite a bit of savings. They still had to qualify at the fully indexed rate, which was no problem. So that provided a tangible benefit. The cons, and this is something that I'm going to highlight and put a big red flag up. Your risk appetite should dictate whether or not an adjustable rate mortgage is the best option for you. When you get a 30-year fixed rate mortgage, you know what your mortgage payment's always going to be from the mortgage payment. If your taxes change, your housing payment can change, but your mortgage payment is going to stay the same. With an adjustable rate mortgage, you are now opening yourself up to changes. Now, thinking about the market, everyone's had expectations for lower interest rates, probably for a little too long. And Looking out further, we can't even tell. We do this on a weekly basis. We don't know where interest rates are going to go next week, next month. How could we know where they're going to go in 3, 5, 7 years? But we know that we are in a high inflationary environment right now. The Federal Reserve is very involved, and the market is waiting on their beck and call for whatever information and guidance they provide, what their monetary policy reflects. So expectations are this is an inflection point, and this is not something that is normal due course. Well, when inflation comes down, the expectation is lending rates should, go down. If you get an adjustable rate mortgage, you may be leveraging to wait for rates to come down, and you could catch that. So like I said, some of the adjustable rate mortgages, if you understand what the floor is, you may be able to get a lower monthly payment in the future without refinancing or anything because you have an adjustable rate mortgage. Best case scenario. Worst case scenario is rates go up. And 5 to 7 years from now, that's a long time. We don't know what that market looks like. In the initial lock period, you can refinance. So let's say 3 years from now, mortgage rates for 30-year fixed matches what your current adjustable rate mortgage is. If it makes sense for you to refinance, you can do that. But you got to exercise good judgment. Adjustable rate mortgages introduce quite a bit more intricacies and more for you to consider when you're making your decision for your financial planning and for management of that mortgage moving forward. So there are pros and cons. Pros, quite frankly, a little bit more immediate than looking at the long-term pros. And the cons, not quite cons in the immediate future, but there could be detractors to that in the long term. So it's very important to understand these things, and it's very important to have quality conversations with your mortgage professional. This is something that I would very much encourage you to reach out to me on. I'm going to give you my email right now, peter.d'angelo@rate.com. If you've been a home buyer and affordability has been a challenge for you, particularly if you're a first-time home buyer, let's talk. Let's talk about adjustable rate mortgages, see if your risk appetite is appropriate for it, and maybe this is something that can help you with that affordability to get more buying power and be a little bit more effective in the current market. That's it for me today. I hope you found this information helpful and useful. I'll tell you, we've got a lot going on. I'm very excited to be sharing all this information and all these updates every week. Please like, share, subscribe. We're on YouTube with the show now and quite a bit more active there. If you like these Did You Know segments, I do separate them out, have a separate playlist on YouTube. So follow me there, Peter D'Angelo. Search it on YouTube. You can even search Mortgage Markets and More. We'll show up there. Also, if there's anything that you would like to hear covered on the show, anything that's interesting to you, anything that you would like to hear with a deep dive, reach out. I gave you my email address. You can also follow me on socials. I'm on Instagram at peter.d'angelo.rate, R-A-T-E. Follow me there, DM me, shoot me a message, and I'd be happy to hear from you, get your feedback, and gear some information to what would be helpful and useful for you, if you're a real estate professional, for your clients. I look forward to giving you an update next week and seeing how this market develops between now and then. But in the meantime, have an awesome weekend and take good care.